Hi there, everybody. It's Ifti from Extreme Returns. Thank you very much for joining me on a financial analysis. We're going to go through lots of numbers together, so sit back and relax. Quick biography about myself. I qualified as a chartered management accountant, worked for big blue chip companies like Unilever and Mars, went into recruitment consultancy, and then I set up my own businesses, first an estate agency and then later car hire. I've been featured in the BBC, Independent, and other newspapers as well. I thought we would do a financial analysis of one of the stocks I own. As you can see, this blue star means that I'm part of the Popular Investor Program and I'm a cadet. That means that other people can copy my trades. So stats so far, I've only had this account for a very short while, although I've had another account on Etoro. They wouldn't let me keep the name well, it's a long story, but I had the name of Ifti, and they said, no, you can't change it to Extreme Returns. You have to start all over again. Results this month are quite good. We're on the 6th of January. The markets haven't opened in America, and we're up by 3.39%, largely because of Bitcoin and Ethereum. So in my portfolio, I'm going to analyze one of the stocks. Yes, you can see I've got Ripple and it's gone down. I'm going to hold it because I think it's a good investment long term. I think the SEC are going to lose. I hope so anyway. Anyway, this video is about Google. So what I thought I'd do, Google is known as, the holding company is now called Alphabet. And the reason for that is because they own so many other companies other than just Google. So let's just take a little look at what they do have. Some of the exciting things about Google. So internet products such as Access, Calico, Capital G, Nest, GV, Verily, Waymo, which I think is the most exciting thing. Self-driving cars, they've been testing it way longer than anybody else. And I'm surprised they haven't really launched it. They're going to give Tesla and Apple a run for their money. They've got things that they call other bets. Very interesting company. 1 day a week, Google employees can work upon anything which they want. They don't have to take any permission from anybody. They've obviously got YouTube as well, which is massive for them. It's not making much money. I think it will in time. They're into the cloud in a big way as well. They've got Android, so many different parts of their business. They're based in Mountain View. I've been to their offices. It's huge. It's like a small city, and all you do is drive around and you see nothing but Google offices. It's in San Jose, which is part of Silicon Valley. Stockopedia, excellent company. I highly recommend them. Do subscribe to them if you want. Quality-wise, 87 out of 100. Quality means the quality metrics financially. So return on capital employed is just under 14%. Return on equity is 17%. Operating margin, 20%. Really good on all those metrics. Value-wise, 33. So the kind of things they look at is PE ratio, the PEG ratio, dividend yield, and EPS growth as well. Momentum, the kind of things we look for here is the relative strength, i.e. how is it doing compared to the broader marketplace. You can see it's down in the first, compared to 1 month, ahead compared to 3 months, down slightly for 6 months, well ahead for 1 year. So let's look in a bit more detail. Revenue-wise, they've grown from 66 billion in 2014, and they kept on growing and growing and growing. In fact, even in spite of the pandemic, which did hurt them quite a bit because a lot of companies stopped advertising, and this is where their main revenues come from, they managed to still grow. And next year, this year, I guess it is now, isn't it? 2021, they're expecting to bounce back in a much stronger way. Compound annual growth rate, that's what CAGR means. So when you take the average, it's just under 20%. That's excellent for a company of that size. If you look at net profits, it's very, very similar, practically the same, which means that they're growing for all the revenue they're growing, it's going straight down to the bottom line. Some companies grow very fast but can't translate their growth into profit. Google can, and that's a sign of an excellent company. If you look also at earnings per share, it's growing at roughly the same level, just around 20% level. Operating margin has been declining somewhat. I think largely, but it went up here slightly. I think that's because they are now investing heavily in businesses other than the Google search engine. And inevitably, with any new business, you have to put a lot of money into it, and it will hurt your operating margin in the short term. Return on capital employed, this is a really good metric. It just means that, well, how well a company invests its money to create more money. And we've seen businesses with a lot more and a lot less. So this is not bad. It's I'd say somewhere in the middle. The most important metric, in my opinion, if you're looking at just one metric, would be free cash flow. Now, free cash flow means the cash which is left over to the business when everything has been paid for. And it's looking at it obviously from a cash perspective. So there's no accounting games, there's no tricks, there's no accounting for depreciation or anything else. The fact Google can grow their free cash flow at more than 20% per year is really, really good. If you look at their cash pile, it's doubled in 6 years. So I think it's about time Google started paying some dividends. If you can see here, they don't pay any dividend. Price earnings ratio is probably the most widely used ratio. It just means how expensive are they? They're relatively expensive. Although I recommend people look at this metric, which is not used as much. It's price to free cash flow. It's the same as the PE ratio, but it's using it from a cash perspective as opposed to an accounting perspective. Accounting and cash are two very different things. We're not going to go into that now, but just take it that I think people should look at this metric, and it's actually higher. So it's more expensive in cash terms than it is in accounting terms. So what that's saying is it's a bit expensive. However, that 33 in terms of value, although it's low compared to other companies, I mean, look, I'll show you. Let's look at Apple, for example. So PE ratio and value. So value is 21, PE ratio is higher for Apple, and their free to cash flow is actually lower than Google's. Look at another top 10 business in America, and you're looking at Tesla. Now their value is only 2, PE ratio is 189. On a cash flow basis, they're even worse than that, 381. So when you look at Google in terms of value, they're fairly reasonable, although the PE ratio is saying that they are slightly expensive. But you have to compare it with other US tech stocks. One of the reasons for that, I think, is because they have an antitrust issue with, well, they've been taken to court by the American government, the SEC, who think they're being anti-competitive. I don't think that's going to go very far. I don't think they'll be successful in trying to break up Google, for example. But even if they did, I don't think it's a big issue, because I think that share price would go up even more. Pre-pandemic, they were 1485. What are they now? They're 1740. So they have grown, but not nearly as much as, say, Apple, who grew more than 70%, nearly 80%. But it's not bad. A 25-30% increase in value is not too bad. They're 6% off their 52-week high. Moving averages are still ahead. So what all that means, moving averages means take the 50-day average of its share price. How does it compare to today? Is it going up or is it going down? And it's in an upward trend. You can see that from here actually. Although they dipped here, then afterwards they've been going up. So that's Google. I hope you enjoyed that. My name is Ifti from Extreme Returns. I'd be really grateful if you guys could subscribe, like, share, and also if you've got $200, why not copy me on Extreme Returns? I'd really appreciate it. I'm also going to give my wife a good plug as well. That didn't sound right, did it? She's got Asian tigers. Her name's Adiva. Now her stats are even better than mine. She's got 3.61. She's investing in some companies like Nintendo, the Far East, really, as you can tell from Asian tigers, Samsung, and a lot of the Chinese up-and-coming ones, Li Ning. I think they're like Nike. So if you could give us a like, a share, and Copytrade with us as well, that'd be really appreciated. Thank you very much, everybody. I hope you enjoyed it. See you guys very soon. Take care and bye.